So think about it this way, Rana. You put up 100% of the capital. You took 100% of the risk, and you got 1/3 of the return.
Yeah, not a great deal.
If that seems like a great deal to you.
Well, so this is something you and I have talked about a lot. You've written a lot about speculation, about the divide between Wall Street and Main Street. And I know that you have thoughts on how the role asset managers might play actually in bridging some of that gap. Do you want to talk a little bit about those issues?
Well, first we start off with a simple kind of an equation, if you will. And that is when you take the total return of the market, that's the return that all investors share in gross, and after you take cost out, it's a loser's game. Investors lose to the market. Total market has, however measured, S&P 500, total stock market, it really doesn't make much difference. That total stock market index, the old Wilshire 5000, and take out about 2% a year for the cost of investing. And it may sound a little high, but you have like a 1% expense ratio for a typical mutual fund. A typical mutual fund turns over at about 80% a year. Just think of that. Short-term trading, and that's the business. Average holding period for a stock, I don't know, a year and a half, something like that. And that costs money. And if you say that costs another percent, that's the 2%. And you've eliminated the fees of an investment advisor to pick the fund, another 1%. You've eliminated sales loads, you haven't counted them. That's another 1 or 2 or 3%, however. So 2% is really a decent but moderate estimate. And so if you're in the market for a lifetime and you earn don't hold me to this, I think I just did maybe 50 years, and you earn, let's say, a 7% return, you'll end up with, say, $30 per dollar, something like that, invested. And if you do it and earn 5%, that's the 7% in the market, less the 2% playing the game, you end up with $10. So you've given up 2/3 of your return, $30 versus $10. You've given up $20 of return to the market system. So think about it this way, Rana. You put up 100% of the capital. You took 100% of the risk, and you got 1/3 of the return.
Yeah, not a great deal.
If that seems like a great deal to you, maybe I'm not making myself clear. So all this depends on a long-term time horizon. Doesn't matter much in a year. All this depends on low cost, which has come totally into its own. And all of this accounts for the burgeoning of indexing. In the last decade or so, about $2 trillion has flowed into index mutual funds, and about $1 trillion has flowed out of actively managed funds. That's a $3 trillion shift in investor preferences on an asset base that probably averaged $6 or $7 trillion, 50%, something like that. So it's a major shift that means that people are finally recognizing the importance of cost as reflected in indexing. And it's going to continue. Indexing has gone from when I started the first index fund, it was obviously 0% until that fund got started. And as a little anecdote, I met with the underwriters. We had the 4 largest retail underwriters for the first index investment trust, now the S&P 500, Vanguard S&P 500, back in 1976. And they thought they could do $250 million. Think we can hit $150 million, okay. $100 million looks sure. I know we can get 50. Think we can do 25, okay. And they hand me the check, $11,300,000. $11 million instead of 250. And one of the underwriters said at one of these kind of catch-up meetings, you all know what they're about. There might be a cocktail involved, and there might be a lot of old anecdotes involved. And one of them said, how is it possible that the worst underwriting in the history of Wall Street could be the most major innovation in finance, probably in a century?
Well,